The IMF has given us horrible warnings, and JP Morgan has given us further cautions. The terrible advice they provided us lately was followed by even more warnings. The Bank of England is completely suffering as well, and Putin has gone completely off the road, exacerbating the wheat problem and the situation in the Baltic Sea. As of today, these problems are quite concerning. However, such tactics are occasionally required to achieve market capitulation and a bottom. But for today's video, this is Investing Path, and we will be delving deeper into these matters and what it means for us and the overall stock market. Now, before we begin, please make sure to give this video a thumbs up and make sure to hit the subscribe and bell button to stay updated for more of our future uploads. But for now, let's get started. The International Monetary Fund then reduced its lending rate. It's complete nonsense to expect the world's economy to develop at a rate of 2.7%. When January rolls along, whether it be last year or this year, we will be in the red. In May, they predicted 3.8% growth, and in July, they predicted 2.9%. Now, they are predicting 2.7%, but we wouldn't be surprised if by February 2023, they'd look back and say that we are totally in a recession. There have been 2 consecutive quarters of negative gross domestic product in the United States. We are in a recession. The International Monetary Fund went one step further and predicted that by 2023, Americans would feel the effects of the recession. That's what the head economists predicted, and it's alarming since it usually means layoffs. In that instance, you will be fired from your position for good. When that happens, people start selling their homes because they have to, rather than because they want to attempt to time the market, and later, the panic sets in. The IMF doesn't trust or lagging comparisons, or more accurately, lapping comparisons, in which we claim lower inflation today based on the last year's high inflation levels. The significant inflation experienced at the close of 2017 and at the beginning of 2018 will have largely subsided now. They anticipate global inflation will peak at 8.8% later this year, and stay elevated for the foreseeable future, falling to 6.5% in 2020 and 4.1% in 2024. It's possible that the Fed will adopt a tough stance between now and 2025 if we are in sync with that scenario. If you're hoping for a poor 2022, you can forget it. Despite what you may have heard about 2023, this year is not going to be that bad. This looks like it will be a dreadful situation for just a few years. JP Morgan has come out with further information, including the fact that the release of time of Thursday's CPI is 5:30 a.m. If you're interested in seeing me live, I'll be there. I plan to report it when it happens. Bloomberg and JP Morgan forecast that CPI will decrease to 8.1%. If the headline number is higher than 8.3 according to JP Morgan, the SP will fall under 5%. The decline occurred on September 13 and was 4.3%. Additionally, we have a somewhat unsettling chart when it comes to multiples, as we have previously discussed the theory that, hey, the first phase of market crash is multiple compression, and that the second phase is an earnings recession, and that maybe phase 1 is complete, that multiple compression is completely wrong. The ratio of SP 500's price to its earnings has remained quite stable at around 16 to 17 recently. Where the thin red line crosses the white text, that's probably where the problem lies. Right there. It looks like we have a chance at an extra 10 to 1 alignment with another half of those arrows. Therefore, there are still 10 to go in multiple compression alone. Hopefully, the upcoming earnings season won't be as horrible as we think, and it's not even earnings compression yet. The last 2 revenue cycles have been quite successful. With the exception of Netflix and a few others, the first quarter earnings cycle was generally positive, while quarter 2 was solid. We can afford any bad news right now. So we're crossing our fingers for a strong quarter 3 as well. It's true that good news can come with bad consequences, as they warned in January. The situation in the United Kingdom is just as terrible. A few weeks ago, the Secretary of the Exchequer announced that the maximum income rate will be lowered from 45 to 40% since the United Kingdom is a nation of entrepreneurs. The Great British Pound dropped the same night. He supposedly went out drinking with hedge fund professionals. Investors were concerned that Britain was boosting too much by enacting some of the largest tax cuts in over 50 years, including cuts to the property tax, the stamp tax, energy subsidies, and corporate subsidies. For this reason, the currency sold off things to such a degree that pension funds nearly went bankrupt as their bonds and some longer-term assets started becoming valued at nearly nothing. After the value of the pound plummeted and market volatility increased, the Bank of England's emergency financial stability arm stepped in to stabilize the market by promising to buy an infinite quantity of bonds for a period of weeks. The pound has settled into a pattern about 11 US dollars. To prevent what it calls a fire sale in bonds, however, the Bank of England announced today that it must broaden the scope of its bond purchases. Its quantitative easing to include inflation-linked debt. What it means is that things are deteriorating rapidly. The level of volatility is increasing, not decreasing. The only thing you need to do is glance at this chart. There's no need to know anything about bond volatility, bond skill, or anything else of the sort. Consider this to be little heartbeats. When they accelerate to the right, this leads to a vicious cycle of negative outcomes since the very act of quantity easing works against the goal of boosting inflation. You've eased austerity measures by buying an infinite quantity of bonds. You've stated that you'll be increasing interest rates in an effort to curb inflation, but you've also been increasing the money supply. The problem is that it sends the wrong message to other nations and trying to reduce inflation, which is impossible if you print money while you raise interest rates, which in turn creates moral hazard for pension funds. Perhaps some businesses truly are terrible and ought to be allowed to fail. However, this raises the question of whether or not millions of people who count on pensions will actually stop receiving them. It's at that point that you realize you are too big to fail, and that the bond market in your country is beginning to show signs of stress as well. On Bloomberg, Boca Capital Partners Chief Investment Officer warned of emerging disturbances in the domestic bond market, that which JP Morgan and Ben Bernanke now refer to as possibility for a financial accident or disorder is quite comparable to this. These are terrible expressions, and they suggest that things are about to grow so awful that a vulnerability somewhere will be revealed. 4% on the 10-year treasury is bad news for real estate, and that semiconductor industry is in shambles thanks to a 32% drop in Samsung's profits, a 6% drop in Taiwan's semiconductor market, and the complete destruction of Nvidia and AMD. But don't worry, Nancy Pelosi has already sold Jamie Dimon's prediction of a 20% drop in the SP 500. Meanwhile, spreads on everything from Apple bonds to mortgage bonds are increasing. Not only are the rates going up, it's the spreads as well. In other words, the spread between the risk-free rate and the rate they are targeting is expanding, which raises alarm bells about the potential for widespread market contagion. It's possible that something catastrophic will happen in the next 4 months, but we can't be sure. If it does, market participants are likely to panic and sell off a lot of their holdings. There are no assurances that things won't get much worse before that day, so you should get ready for it. For now, our only advice for you is to do not stop grinding. Find a second job and boost your income. Money is king at the moment. Get out there and consistently put in the work. Spend the next 2 years working tirelessly, and if you put in the effort in 2023 to 2024 and make some connections in the market, you can set yourself up for life in the years to come. And so, that's we all have for today's video. Thank you so much for watching. We hope you enjoyed this one, and if you did, please make sure to give this video a like, subscribe, and hit the bell button to stay updated for more of our personal investment and financing content. Once again, this is Investing Path, and we'll see you on our next video.